Hello and welcome back, everybody. We are thrilled to jump into our next session, which also happens to be our final session of the day before we're back tomorrow. So I'm Reda, head of content here at Finimize, and I have the absolute pleasure to be joined by three incredible guests. We have two so far, and hopefully the third will join in a bit after some technical difficulties. But three incredible guests for our final session of the day on the market outlook for 2026. Now, please allow me to introduce on the call already David Kelly, Chief Global Strategist at JPMorgan Asset Management, Jan vanEck, CEO at vanEck, and hopefully joining us very soon, Solita Marcelli, Global Head of Investment Management at UBS. David, Jan, it's a pleasure to have you both with us, all of you with us today, and welcome to the Modern Investor Summit. We have a 30-minute, very exciting panel discussion today, and let's get straight into it. And perhaps for the first two questions, we can go around each of you because I'd love to hear all of your thoughts. So my first question is, as we stand at the end of 2025, what do you believe is the single most important theme, be it economic, political, technological, that will define market performance in 2026? And Jan, perhaps we can start off with you.
Sure. Thank you. vanEck's approach towards asset allocation to markets is very much from a multi-year perspective. And I love, multi-decade charts and things that are at absolute extremes. So what's at an extreme? We had two things. Number one, U.S. government fiscal deficits were at 250-year extremes 2 and 3 years ago. So one has to account for that in portfolio construction. And then secondly, obviously, we have this huge technology of AI that's hitting the American consumer. So, the fact that hardware and software is more efficient and all that kind of stuff is happening every year. But I think what's so interesting is a challenge for dominance and interfacing with the U.S. consumer, mainly, as posed by OpenAI, the upstart new entrant in the kind of American consumer landscape. So just to drill down on that, let me just drill down on the fiscal budget deficit and frame it. I would say it's boring to talk about, and we can kind of put it in the background. I think 25 was a good year of progress in the budget deficit in the sense that the prior fiscal year budget deficit was 6.5% of GDP. The last budget was 5.9%, so significantly better. And we're projecting a 5.5% or better deficit for the current fiscal year. So it's basically a risk that's receding in the background, but I can't not mention it because we have the US Supreme Court tariff decision coming our way and midterms, which are stacked against the incumbents, meaning the Democrats will probably win, meaning there might be additional pressure to spend money, coming out of what's going to happen in 26. So, David, let me turn it over to you, for that, with that.
Yeah. So I think looking forward to 2026, you can the economy and markets are both in a fine balance right now. You've got a definite tailwind coming from AI, but also from all the capital spending, all the companies enabling this AI boom, and also really from a widespread series of technology improvements. I mean, we really are on the cusp of a technological golden age, if we can seize it properly, with advances in not just AI, but also in genomics, in power production, in battery technology. I mean, across the board, there's huge technology advance that is powering the economy. And I think this booming stock market is also generating a lot of wealth, which is helping consumers. On the flip side, we have the forces of nationalism, geopolitics, economic nationalism around the world. I think the tariffs, a reduction in the growth in the workforce, these things will restrain the economy and create uncertainty. And as Jan said, I think we're going to have we have uncertainty around the Supreme Court and tariffs. I don't quite share his optimism on the budget deficit. I think the budget deficit last year was flattered because of an accounting adjustment for some student loans, and I think the effects of OBBA on income tax refunds are going to boost this deficit this year over $2 trillion. So I don't think we're getting much improvement, but that's not the biggest factor. I think you've got this fine balance. And the real question, I think, honestly, is there going to be some shock, good or bad, that upsets that balance? There are plenty of potential geopolitical shocks out there. There are plenty of domestic political shocks out there. There's also potential at any point here for a significant market correction if people get scared that maybe some of these mega cap tech stocks have gone too far. So when we look back at 2026, we're going to see, I think an economy that was poised to in some ways be kind of boring, but I bet we don't end up with a market that's boring, and it's probably going to be decided by which way the shocks blow here.
That's very interesting. And I have, a quick follow-up, because you both mentioned the deficit. You both have perhaps, different opinions about it. But for investors watching this, like, how will it matter to them? Will the impact mainly be felt in the bond market, for example? If the deficit is not under control, will investors start to question the perceived risk-free status of treasuries? Or do you think we'll get a spillover to other asset classes?
Go ahead, Jen.
Well, I mean, I do think that the progress in the budget deficit, mainly from the tax hikes or tariffs, right, however you want to frame them, have caused the 10-year to fall, right, from the highs of 4.8 to about 4% where it is now. So I would say the good news for investors, I always think, by the way, it's our job to say, stay invested in the markets, because over time, your returns of compounding are going to do way better than just leaving your money in the bank. And so no matter what I'm saying about risks, I would say stay invested. What I was going to say is that in 2025, we kind of had a free lunch, because gold could act as a good hedge against these fiscal deficits. And gold performed really well, I think, for secular reasons. So you kind of, gold shares are up 150% this year. Gold's up, 50% or so. So it's so if you included some kind of protection against that deficit tail risk, you weren't happy at all. You weren't unhappy at all with that. So that's how I would construct a portfolio, and I would keep that gold position for many years in the future.
I wouldn't necessarily make gold my alternative asset of choice, but I agree with the general perspective here. I think, yes, we've got 10-year treasury yields down at close to 4%. I think those are very low, given just how much money the government is borrowing. And I think it speaks to the fact that investors are, there's a lot of liquidity. Investors are looking for a place to invest. But what I think these deficits do mean is that if the stock market zigs, bonds may not zag as much as you would like them to. In other words, you get a big correction, you get a 20% correction or a bear market in stocks. You're not going to get that much out of it. Typically, the duration on bonds is low enough, you're not going to get a big kick anyway. And second of all, you are going to still be dealing with some inflation. I don't think the inflation is going away. I think tariffs will add a bit to inflation. I think further fiscal stimulus could also. I think one of the things that I worry about is we're going to have a huge amount of fiscal stimulus coming out of refunds due to OBBA starting at the start of 2026. But it's quite possible that if the economy softens over the summer, this current Congress could well pass another bout of stimulus to try and warm up the economy ahead of the November elections. And if you get sort of tariff rebates and then the tariffs go away, then you've suddenly got more fiscal stimulus, which could keep inflation high. And I think, again, that limits the amount that bonds are going to protect you. And I think, we've had 3 extraordinary years in the stock market. There are a lot of people who are a lot richer than they thought they would ever be. And I think the name of the game in 2026 is, how do I protect what I have accumulated? And I think part of the answer to that is, yes, have a more diversified portfolio, have bonds in it, but also have alternatives. And, as I say, gold isn't necessarily my alternative choice, but it's one. I think other alternatives like infrastructure, like global transportation, maybe some private equity, take advantage of some of the AI themes out there. AI isn't just about mega caps. There are so many technology themes that you can play here, given all the advances in technology, to take advantage of them and have money invested overseas. If something goes wrong here, the dollar goes down, International stocks are a lot cheaper than US stocks. It's another way to diversify. So I think this is a time to be really thoughtful about how you invest, because markets have done very well, but they are vulnerable to a shock.
Really, really fascinating. So basically, you're saying, bonds might not have that historical role they've played before in terms of, protecting your portfolio when stocks are not doing too well.
Yeah, and you have to go beyond a 60-40 here. I think you have to add in other asset classes.
Absolutely. And, circling back on something, you both mentioned one way or another, AI, big tech stocks, etc. There's a lot of talk about the B word, right? And very curious to hear your own opinions. Do you think we are in the middle of an AI-driven market bubble? Or do you think valuations are, justified given the long-term potential of the technology? And Jan, perhaps we can start with you.
Sure. I mean, look, as I said, these are not minor stakes. They're fighting for market share of the American consumer economy. So the Mag 7 or 8, as I call them, it's a very serious fight. It's fought week to week, and using all kinds of, obviously heavy expenditures on the hardware, what I call the hardware and software side. What I'd like to just make a quick point about OpenAI, because first of all, on the upside, it's a remarkable company. They basically popularized AI prompts, with the chat that came out in 23, number one. And then website traffic is how we interface with consumers, whether it's JPMorgan or vanEck. And about 0 to 20% now of website traffic is coming from the AI prompts. That's sort of interesting. It's very low for a company like Walmart today that has a big digital footprint, but that's expected to rise over the next couple of years. But what's dramatic is that of all that AI caused traffic to websites, 90% of it comes from OpenAI. So they really have a dominant position. So that's what. Let me extol Sam Altman and say why that's good. Now, to answer your question, they are also the weakest pillar by far, I would say, in sort of the AI ecosystem, because they just don't have existing revenues to pay for all their CapEx spend. And so they're having to leverage partners for capital, get more equity investment. And you can see companies like Oracle that were borrowing to create some of this compute power are really being punished in the market. So their stock rallied 25%, it's given it all up. And so that's what you've seen in the markets recently. And that's really the risk factor, I would say, to look at in this AI build out is OpenAI. On the one hand, they're competing head to head against some of these other Mag 7s. On the other, they don't have the financial backing and existing revenue to kind of support it. So I think what the market is showing you now is that the market's very smart on this. And if OpenAI were a public equity, I think its stock would have fallen quite a bit recently. Of course, it's private, so it's protected there. But part of that ecosystem, like the Oracles, you'll see there's a sorting out of winners and losers. And the last thing I would point out is 2025 has been a year of rotation in the Mag 7, right? Only 2 of them, I think, have outperformed the S&P, and Meta has way underperformed Google, for example. So it just shows you it's a very competitive football match that we're watching here at the highest level.
Absolutely. And just perhaps really quickly before we hear you out, David, if we can just bring Solita in. Solita Marcelli, Global Head of Investment Management at UBS. Welcome to the Modern Investor Summit. So we were discussing, market bubble, if AI is in a bubble, and we're about to hear what David has to say, and then I'll pass the question to you, Solita.
Okay, great.
Yeah, thanks, Rita, and welcome, Solita. So I think we do. There may well be a bubble in certain parts, in certain individual stocks. I think that people have asked, is this 2008? No, it's not 2008. It's not the pandemic. There are plenty of similarities with the tech bubble and plenty of, or the .com bubble, and plenty of important differences. I think the similarity that we've got to recognize is we're dealing with completely new technology, completely new markets, and a technology that's going to change the economy of the marketplace in ways that we can't predict. And that means that it is very difficult beforehand to identify the true winners and losers. The real lesson from the dot-com bubble wasn't that, it wasn't a tulip mania, because there really was something there in the internet. It made a huge difference. The real trick was, could you identify the companies which are giant names today, which are the few companies that would succeed in the dot-com bubble era and thrive as they rebounded from it, as opposed to many, many hundreds of companies and thousands of smaller companies, I suppose, that just bit the dust. And I think this is a little different, because then it was dominated by small companies who frankly had no revenues, and they did a sort of wing and a prayer. And so if the bank takes the money away or the bondholders take the money away, they're kind of stuck. Here you've got these mega cap tech companies who've got massive cash flows, which means that they have so far not had to laden themselves with one notable exception. They haven't had to pile on that much debt. Data centers and all the technology involved. And I think that gives some legs to it. I think we're going to go a little bit further here before we figure out who the true winners and losers are. But there will be true winners and losers. And I think that's why, maybe more than in any other era, this is where good active management really matters, because I think you've got to really think about, is it going to be Google? Is it going to be Meta? Is it going to be Microsoft? Is it going to be somebody else or some other combination, or are they going to compete their profits away? Is it going to be a leader that's dominant for a long time, or is the leadership going to switch? And then should you just bet on the utilities, the electricity companies, the chip makers that are supplying this, and not try to pick the winner? So I think it's a complicated investment process. It may well involve a market correction, and a big one at some stage, and it's certainly a very big one for individual companies. That's going to survive any market correction. I think it's going to give legs to this AI revolution, and I think we'll see some exciting things. To quote the Eagles, it could be heaven or it could be hell in the years to come. Solita?
Yes. Thank you. First of all, thank you for your patience. I had some tech issues coming in, but here I am. So on this question of bubbles, look, history shows bubbles share, I guess, three traits, right? A significant innovation, sharp gains, and eventually a disconnect between prices and fundamentals. And artificial intelligence clearly checks the first two boxes. But I think the third is where the bubble argument sort of breaks down. Valuations are clearly elevated, but the gains that we have seen have been supported by real earnings growth. And compared to the four horsemen of the 90s, the Intel, Cisco, Dell, Microsoft, today's leaders also have stronger earnings, more reasonable multiples, and healthier balance sheet. Of course, many concerns have centered around the scale of capex, but we forecast that as a share of global GDP, this investment cycle will be on par or smaller than past investment booms, like the build out of railroads or early computing. And most spending, similar to what David was saying earlier, has been funded by operating cash flow, not debt or equity raises. And we also don't think this spending will be wasted, right? Even if AI automates a third of labor and vendors capture just 10% of that value, annual revenues for end users could approach almost to $2 trillion. Now, that being said, I think everybody recognizes the easy gains may be behind us. The market's negative reaction last week to NVIDIA's record results signals a clear shift in focus from capex to revenues. So while higher valuations may be justified currently, I think we need to see signs that we can continue to grow into those multiples. It is true that I would say so far monetization has been lagging, but we do expect enough progress this year to keep the momentum. I guess I shouldn't say this year, next year, 2026, to keep the momentum going and propel stocks higher. It just won't always be a straight line. So I think it will also become increasingly important to start to diversify beyond the infrastructure builders to companies in other sectors using AI to cut costs and grow revenues. Healthcare, financials, those are two industries where we see a lot of immediate potential at this time.
Really, really fascinating. And yeah,
really, could I just add one comment, because Solita triggered my favorite technology, which is railroads. I think the question, to put it differently, is our market structure is very weird right now. Only 10 companies are 40% of the S&P. And so is that a fundamental warning signal? And obviously everyone on the Zoom has studied that issue. And I think what is amazing about these mega cap stocks is, again, AI is a scale economy, because the more searches you have going through your prompt, right, the better your answers are going to be, the more valuable your product is. So yet again, the bigger advantage, and that's on the positive side, and that's why their revenue is growing, as we can see every quarter. But what's awesome as well is that AI cuts their cost. So if you look at the headcount of an Amazon or whatever, or Meta, it's actually shrinking on the margin, a Microsoft. So their revenue is growing 10%. If their costs are stable, I mean, it's just a profit juggernaut, and very different from the railroad era, which was the only other era where the U.S. market was so dominated by one industry.
Now, there's just one other thing I want to say about bubbles, having lived through a few of them in my life, but particularly technology bubbles. There is something very positive about a bubble, because it allows the funding of crazy ideas. And the truth is 99% of crazy ideas are actually crazy. And then 1% of crazy ideas are actually genius. And you can't distinguish which is which. And so one of the things that I think is very, actually in a strange way, healthy right now, although dangerous for investors, is that a lot of ideas are getting funded which wouldn't have been funded otherwise. I mean, I think about, for example, the nuclear fusion projects that are going on in a number of companies are actually trying to leapfrog the government's decades-long attempt to produce nuclear fusion, just because the demand for electricity is so great for these data centers. And if we ever crack that nut, that will have tremendous implications for the global economy and for really lifestyles for going forward, because of the nature of nuclear fusion. So there are many technological advances that are being funded here, and we just don't know which ones will be successful. But when you have sort of a flood of cash, fertilizing the entire valley of ideas here, some crazy ideas that will really change the world are getting funding, and that's actually a very good thing.
And for the sake of everyone, in case anyone didn't know, nuclear, fusion is literally replicating the sun, but here on Earth, basically promises infinite energy, which would be
infinite energy with no global warming and no nuclear or radioactive materials being created. So it's
absolutely
an amazing objective.
Solita, I have a question for you. So earlier, David mentioned that the 60-40 portfolio is not sufficient anymore, and we need to seek alternatives. Obviously, 60-40 is a classic example of strategic asset allocation. But one shift we've been seeing this year, and CalPERS, the huge pension fund, adopted this approach very recently, is what's called the total portfolio approach. So we're seeing a shift of big sovereign wealth funds, pension funds, moving from strategic asset allocation to total portfolio approach. I'm very interested. Are your clients, because you advise a lot of clients, are your clients, adopting this approach, and how do you think about all of this?
Yeah, I mean, great question, because as you mentioned, we've seen a lot of buzz with this approach, which looks at a portfolio as one integrated organism, right? Instead of different asset classes. It's meant to be more dynamic, factor-based, and goals-based. And it's become really more prevalent as traditional correlations have at times broken down. And as also specific themes like inflation or AI that we just spent quite a bit of time on have disproportionately driven market performance. So from our perspective, we haven't thrown out our traditional strategic asset allocation out the window just yet. But we already incorporate elements of total portfolio approach, TPA, into our investment process in many ways. So what do? First of all, we apply a tactical overlay to our strategic allocations and review those overlays regularly. And when we do make changes, we're taking more of a total portfolio view. What would be a good example of that? For example, we constantly look at our portfolio's exposures to certain factors, especially growth, to further diversify. This means not just adding or decreasing the share of equities and bonds, but also increasingly considering real assets like commodities that have different sensitivities and correlations. Now, we've also been thinking less about public and private markets as distinct categories and more as different ways to get exposure to unique return streams, especially as there are more accessible and liquid structures like evergreens, these evergreen funds. And I would say finally, similar to a total portfolio approach, being goals based has become core to us. We actually take it a step further with what we call a total wealth approach, where we work with our financial advisors to segregate client assets into 3 purpose-built strategies. One is liquidity for short-term spending needs, and then the second is longevity for lifetime needs, and that's where we have vertical diversification. And then the third one is legacy for assets to give away maybe after their lifetime, right? And we've often seen that clients who think about their wealth this way are much more confident, and they have the most willing to stick to their plans when volatility rears its head.
Yeah, makes perfect sense. Very interesting. Thank you very much. Jan, I have a question for you. vanEck is a major name in thematic ETFs, but very curious, beyond AI, which is very hot, and a few other kind of hot themes out there, do you see any particular themes that are going under the radar, underappreciated, not getting the spotlight they deserve from investors at the moment?
Yes, absolutely. I mean, in 2025, we have very much played that what we call the AI 2.0 trade, which is the shortage of electricity in the US, and nuclear, which I saw you were talking about before, has been our most popular thematic in the US and Europe this year. I do think some of those valuations are a little stretched, to be honest. So I think what I include in the scope of thematics is also countries. And a country that I'm very interested in is India as a long-term overweight. If you look at the trajectory of India's economy, it's supposed to match the size of Europe in about 10 years. So it'll be the 4th major consumer economy in the world, which means it should be breeding companies that can also be global competitors, like China, the US, and Europe have done. The other thing about India in 2025, it underperformed EM and everything else, which makes it maybe more of a buying opportunity in my mind. But yet, it enacted a whole bunch of very interesting continuation of reforms. This year, they reformed their bankruptcy law, which decreased the uncertainty. The reforms will decrease the uncertainty about bankruptcies, which is really important. If you lend to a company that goes bankrupt, you want your money back in a matter of months and maybe only a year or two. You don't want to wait 10 years. And so the bankruptcy reforms are really important. And then the labor market reforms dated back to the 1940s, when it was sort of a socialist government almost. And so I've been told, because they're different triggers at 10 employees and 100 employees, that the vast majority of Indian companies have either 9 employees or 99 employees, right? So the labor market reforms that have happened over the last couple of weeks will bring many more workers in India into the formal economy, which has been part of the trend. A vast majority of them are now covered by Social Security. So more fluid labor markets are accompanying a lot of other digitization reforms that India has been doing. So I think will continue to be a tailwind for growth. And if investors look at India as a percent of their portfolios, you see it's pretty small. And however, if you look at the last 10 or 20 years of stock market performance in India, it's extremely competitive with the US, aside from this year. So it does have an equity culture. You have gotten good returns on equity, which is super important, right? You don't invest in a country just because you like to go there and be a tourist, right? You want to make money off of your equity allocation. But I think India checks all the boxes. So that's my most enthusiastic thematic for next year.
Really fascinating. And of course, a lot of demographic tailwinds also blowing in India's favor. Not the same could be said a lot about a lot of, developed countries, of course. We have about 5 minutes left. And what I'd really like to do is go through two kind of fire round questions to each of you. So, would love to hear, each of your answers to these two questions. First is, what is your boldest or most unexpected optimistic call for next year? And then second, on the flip side, what's the one black swan or underappreciated risk in 2026 that markets are overlooking right now? And David, perhaps we can start with you.
Yes, it's one of those questions where I'm going to say, I'm really glad you asked me that question. I'm going to answer a different one. because let's be honest here. You cannot predict shocks. As I said, at the start of this, I think we're going into this year in a fine balance where we've got technology pushing the economy forward, economic nationalism holding the economy back, or the forces of economic nationalism, and really the shocks, the geopolitical shocks we might get out of Venezuela or Iran or Ukraine or our relationship with China. These are things that will affect markets one way or the other. But I think for long-term investors, the biggest thing to recognize that people perhaps don't recognize is just how much technology across the board is accelerating right now. And there's so many opportunities. And I think you have to invest outside of the mega cap 7 to take advantage of that. But the other thing I would say so important to people is look at your own portfolio. Half of the story here is what's overpriced and underpriced in the market, or what's over-concentrated or under-concentrated in stock market indices. The other half of the story is, where are you? If you have passively not rebalanced over the, if you've avoided rebalancing over the last few years, then you're a lot richer than you were, but you're also way out of whack. It's kind of like in soccer, you think you're playing a reasonable game, then you discover that the defense has all moved and now you're offside. I think a lot of investors have basically drifted offside here, and I think they are way overexposed to large cap U.S. equities, and they've got low exposure to the rest of the world. And I think they have some fixed income in a portfolio, underweight fixed income, but I think they're relying on it to do too much of the diversification for them. So I think people need to increase international equities, overall try to reduce the risk in their portfolios in a tax efficient manner. And that itself is a really important game. And then take advantage of alternative investments, not just as a defense, but also as a way to capture some of the themes that are associated with this technological revolution.
Very fascinating. Thank you very much. Solita?
Sure. So, look, there's so much talk about the AI bubble popping. We just, had our own version here. But I think the potential for markets to actually melt up often gets ignored. In fact, in our scenario analysis, we assign the same 20% weight to our bear case as we do to our bull case scenario, where AI investment and adoption exceed expectations and economic growth comes in well above trend. Now, if that happens, we see the S&P at 8,400 by the end of next year. So, our bear case, on the other hand, is like 4,500. So I would say, while it's not our base case, that's where I think, we might see maybe unexpected optimism play out. Do I do the black swan now or the way?
Yes. Yes.
Okay. So in terms of the black swan, I do believe inflation remains the risk that people probably have become a bit complacent with. If we see those lagged effects of tariffs and immigration policies hit later, but harder than expected, I think that would be a complication. Tariff inflation specifically has also been contained, mostly because we haven't seen a major retaliation from other countries. But if we have any new tariffs that weigh on specific industries, I think political leaders in other countries could be forced to react. Again, that is not our base case, but I think it's an underappreciated risk that we're monitoring right now.
Fascinating. And last but not least, Jan.
Well, I don't know what a black swan if I could identify that either, or what I would want to, because I think it's a misleading way to construct portfolios. I think, again, the main lesson that we always talk about with investors is stay invested all the time, and don't be scared unless you've got My only reason I would get scared of being in markets is if the Fed were going to tighten dramatically and aggressively, and they're not positioned to do that now. We're actually in the middle of a global easing cycle. I think the things that I would say we had in common, if I can just comment, is that beware of being overweight bonds is something I think that David and Solita both talked about, and I would share that concern as well. Don't just own it because it's traditionally been risk-free. It could very much be the source of risk in 2026. And then Solita also mentioned something that I think is not discussed enough, which is longevity risk amongst investors. If we have some of the breakthroughs that we are promised in the medical field, people will live 20 years longer, and I'm not sure they're saving enough for that. It's raised occasionally, and Solita mentioned it, but I just wanted to underline that as something that's people running out of money at a societal level or at a family level is something that you don't want to do. And so that I just wanted to highlight those two things. I thought they were super interesting. I guess my outside thing is just another year of good gold performance, because I think gold is reemerging as the world's leading currency. China doesn't want to live in a US dollar world. India doesn't want to live in a US dollar world. And so I think gold, we don't know how much China is buying, which I think is underappreciated. And so I think it's just a lot of demand coming for gold globally these days as the core of foreign central banks. And so I can see it having another good year next year.
Really, really fascinating. Solita, David, Yad, on behalf of myself, Finimize, the entire Finimize community, thank you so much. I honestly really, really enjoyed that discussion. Amazing insights across the board. So thank you so much. And for everyone attending, thank you all for joining day one of the Modern Investors Summit. We are done for the day. Enjoy the rest of your day, and we look forward to welcoming you tomorrow for day two. Thank you very much, everyone, and thank you.